Good morning. You are watching the live daily market outlook for Wednesday, 18th of April 2012. Not much action seen during the Asian session except dollar yen, as the yen fell broadly after yesterday's upbeat U.S. corporate ratings and corporate earnings, and the fall in Spanish debt yields, as well as strong German investors' confidence that helped to boost the risk assets. Dollar yen so far gained around 0.7%, hitting the high of the session at 81.45, as yen also comes under pressure ahead of Japan's trade data that are due tomorrow, and it's likely to show a deficit. Some traders also see the expectations of Bank of Japan's easing on April 27 meeting as hampering yen Canadian dollar and on April 27. Canadian dollar holds the momentum after yesterday's Bank of Canada decision to come closer to the rate hike. Euro dollar was flat during the Asian session, moving around 131.20 zone. However, the opening of Europe sees the single currency coming under pressure again, as it currently attacking at 131 support, and with the quite negative structure on the near-term studies, seeing potential of further easing, as well as a larger picture of euro-dollar that is still in the negative mode and sees the downside more vulnerable. Gold was also quiet during the Asian session, holding around the 1640.50 zone on its recent sharp fall from 1686 high of last Friday, with outlook on the near term still in the neutral mode. Crude oil benefited of a recent crisis that comes from Spain, with the latest price action of last week's low at 100.67, extending against yesterday to 105.04, breaking above the near-term range that might signal further extension higher. More of this we will hear on our technical part. And now to come to the burning problem of past couple of days, Spain. The economic experts that are watching Spain do not know how much money will be needed or precisely when, but some are near certain that Madrid will eventually seek a multi-billion euro bailout for its banks, and perhaps even for the state itself. As the main comments were, it's not anymore when, but how much. The Prime Minister of Spain has repeatedly said Spain doesn't need or want an international bailout, and the European Union, which along with the IMF has already rescued Greece, Ireland and Portugal, also dismisses such talk. But economists believe that Spain banks will have to turn to the Eurozone Rescue Fund, the European Financial Stability Facility, for help in covering losses caused by a property market crash, which has yet to end. Likewise, the investors are fretting about the center-right government leading party can enforce deep austerity while reviving a recession-bound economy at the same time. Comments from analysts saying that they are going to need the EFSF money to recapitalize the banking sector, and they think we will see only a real end to the Spanish misery if the real estate market stabilizes. The Madrid is likely to hold out for some time, but underlying picture in the Spain is dramatic. But is it dramatic in the way that it needs a bailout package tomorrow? Analysts say no, but if you look ahead, let's say the next 6 months, they wouldn't be surprised if the banks have to get some kind of European support. Market concerns about Eurozone fourth largest economy have deepened in the past week. Yields on the government's 10-year bonds, which reflect the risk investors attached to owing Spanish debt, have risen above 6%, a level that has proved the trigger point for other troubled Eurozone countries. At the moment, the EU is backing Madrid and Jean-Claude Juncker, who chairs the Eurogroup of Eurozone finance ministers, said Spain was taking the necessary steps to get its economy back on track despite the recession and unemployment at 24%. Yesterday's comments also from IMF appeared to be inching towards a deal on increasing its financial firepower on yesterday's meeting, with Japan, Sweden and Denmark committing a total of $77 billion to help contain the Eurozone debt crisis. The pledges were made ahead of meetings of global finance chiefs in Washington this week that will focus on additional funds for the IMF, an issue that has taken on fresh urgency and given a jump in borrowing costs in Spain and Italy this week. The renewed borrowing woes have reignited the fears that the Eurozone crisis is about to flare again. While a deal may not be fully fleshed out by the time the meetings wrap up on Saturday, it is quite possible that G20 developed and emerging nations could agree on the amount of funds needed to leave it to a leaders' summit in Mexico in June to hammer out details. From today's events, we have the first kicking with the Eurozone current account for February due at 8 o'clock GMT, narrowing the surplus to 4.1 billion euros compared to 4.5 billion euros of the month of January. Minutes of Bank of England, the MPCs of the latest meeting are due at 8:30, and the expectations are as the previous one. No one voted for a rate hike. 9 voted to hold steady, and also again 0 votes for the lowering the rates. Unemployment rate from UK at the same time is also expected to stay unchanged at 8.4%, while average earning index for February is expected to decrease to 1.30% compared to 1.4% of January. Swiss zoo economic expectations are due at 9 o'clock. We don't have the forecast. The previous one was at 0 unchanged. MPC's member Tucker of Bank of England is due to have a speech at the same time at 9 GMT, while in the afternoon 14:30 GMT's Canadian Bank of Canada monetary policy report for the first quarter. US crude oil inventories are due at 14:30 at the same time, with forecast of further build of US crude stocks by 1.6 million barrels compared to 2.8 million barrels build of the previous week release. And late in the afternoon, Bank of Japan Governor Shirakawa is due to have a speech at 22:30 GMT, and the CPI from New Zealand is at 22:45, with the Japanese trade balance at 23:50 GMT, expected to show the negative outlook of minus 0.43 trillion Japanese yen. A quick look now at the markets to see the latest movements of the majors and the commodities. As always, starting with euro. Overall picture is better shown on the daily chart. Remains turned towards the downside, as the upside was still stays capped by the main bear trend line of 142.46, with several attempts failing to break higher. The recent action higher was capped at 132.11, limited by 55 days moving average, as shown here, with the studies still in the negative territory on the daily chart. 4-hour structure is now losing momentum as the pair lost its initial support that was holding overnight just above 131 level, and the other support low, intraday low of yesterday at yesterday's low at 130.89, that is currently under attack, break of which is to open further weakness of the single currency against dollar, and mark the lower top at 131.71. As said, loss of 131 support would risk further extension lower, with the previous higher base at 130.32 offering initial support ahead of a very strong support at 130 zone that has already been dented 2 days ago on a brief break lower, hitting a low at 129.93. As said, the very strong and critical support actually 130.00 and 129.50 range offers very strong support that marks range previous past 2 months range floor, and the 61.8% Fibonacci retracement of the latest rally from the beginning of year's yearly low at 126.22. That was capped at 134.85 at end of February. Loss of this support zone would risk further extension of the broader weakness of the euro dollar, as the downtrend the downtrend exists from beginning of May 2011 of level at 149.38, and so far hit the low at 126.22, which is the low of 2012, posted on 8th of January. Risk is seen on the break of initial 130.00, 129.50 support zone to possibly open way towards 126.22 yearly low of euro dollar, posted at the beginning of January 2012. On the upside, immediate barrier is yesterday's high at 131.71, and more significant 132.11, and only break above this level would avoid immediate downside risk in favor of further extension higher, with 132.50 coming next, ahead of strong barrier at 133.00 and the platform at 133.80, highs of end of March and beginning of April 2012. The British pound also broke below the near-term range, near-term range floor that held the downside from yesterday's afternoon, and during the Asian session at just about 159.00, 159.16 were the lows, and also the 38.2% retracement of move from 158.17 to 159.69. Upside failure to regain a more significant barrier at 159.84 has triggered a fresh weakness, and immediate threat is seen on firm break below 159, where is also 50% retracement at 158.93, as significant supports are already out, 159.10 and 159.10 also is the 55 days exponential moving average that will risk test of the next support, yesterday's low at 158.61, and then we have another very significant supports at 158.40 zone that marks the 200 days moving average and the main bull trend line drawn of 152.33 yearly low. Break below this level and very significant support at 158 zone that contained the dips during past 3 weeks or so would risk further extension lower and weaken the current structure. Several attempts below 200 days moving average failed to sustain losses below this level, and the quick recovery always followed the action. Currently the pair is aiming lower, with the studies on the daily chart weakening at this point. Loss of momentum would risk test of this important supports at 158.40 and 158.00. On the upside, only break above 159.84 and 159.91 current recent peaks would prevent further easing, and they're likely to refocus yearly high at 6061 posted on the 2nd of April 2012. Hourly structure is turning negative now, with also the 4-hour chart studies losing their bullish momentum and looking for a further extension lower. It's important also to mention that near-term price action is been entrenched within 158 and 159.80 range, and the break of either side is basically required to define the future movements in the short term. As said, very strong support at 158.40 and 158.00, and the loss of the later to risk further extension lower. 157.45 and 157.00 would be the next targets in case of break below 158.00. As mentioned in the beginning of the presentation, dollar-yen has benefited out of the recent situation as it now stopped its slide at 80.28, the broader slide of correction of 76 to 84.17 ascent that retraced nearly 50% of the entire move. Temporary support was found at 80.28, where the pair is currently attempting to build the base. Important levels at 81 and 81.18, the previous high of 13th of April, gave additional boost to the pair as it extended so far to 81.42 with break above 55 days moving average. That was at the same level with the previous high on the 4-hour chart. Is looking now for further extension higher. Improving studies on the 4-hour chart are supportive. However, the hourly studies are a bit extended at this point and already in the overbought zone. That might signal a corrective action before the fresh rally starts. 81.18 is the initial support, while the floor of the recent range at 80.70, 80.80 zone, along with the 55 days hourly exponential moving average, should contain the dips in order to keep the near-term positive action in play. On the upside, the next target is at 81.80 zone, which marks the previous lows and the high of 10th of April 2012. And the break here to open way for a more significant recovery with the 82 and the 83.40, the key barrier to come in the possibly to come in the focus. However, the outlook on the daily chart is still negative, as all studies are in the negative territory, with the regain of as said minimum 82.50 required to ease the current bear pressure. Regain of 55 days moving average is seen supportive for the pair for now, but we need to see more significant rally higher in order to ease the current bear pressure. Otherwise, the likely scenario would be lower top and further extension of the corrective pullback of 84.17 peak of 2012 posted on 15th of March. The dollar Swiss held steady above the main trend line at 91.23. This was the low of yesterday. The price was overnight stuck within the narrow range, with this morning's fresh action higher, breaking above initial barrier at 91.80 and looking for a further recovery of the fresh leg higher of 91.23 low of yesterday. Broader picture shows the pair still in the uptrend. Studies the MACD was and is still rather neutral, while fresh momentum that emerged from this morning's bounce higher looks for a further extension higher. The next targets seen on the upside 92 and 92.20, that is previous high, and the break here is required to confirm the higher low at 91.83 and possibly open way for test of yesterday's 2 days ago peak at 92.50. Daily structure is still in the rather neutral mode with break above the trend line that is currently at 92.05 and the break above 92.24 equivalent to the previous high of 90 days moving average, and yesterday 2 days ago peak at 92.50 is basically needed to turn the studies more positive and possibly to refocus our key barrier on the upside at 93.33, high of 15th of March 2012. On the downside, the strong support is at 91.23 and the more significant at 90.90, along with the trendline support that is currently at 90.35. Loss of these levels would loss of this, which is also the triangle support, would risk further extension of the broader down move from 95.93, a yearly low posted on 9th of January 2012. And quick look on the yellow metal as it remains stuck within the narrow range and the rather sideways movement in past 2 days, as the recent pullback of 1686 low so far found support. There was a spike low yesterday to 1634 that briefly broke the previous low at 1641. However, the range is now defined by around 1650 and the 1660 zone, with studies flat on the hourly chart, turned still holding negative tone on the 4-hour chart. Daily outlook remains still negative with the immediate barrier at 1656, 20 days moving average, and more significant 1672 90 days moving average, along with the 1681, the main bear trend line drawn of 1725. Basically break above 1679 and the 1683 is required to improve the structure and open next very significant barriers at 1695, 1700 zone. This is our key barrier on the upside, and the break above these levels is to return positive, bring back the positive tone for possible test of the next levels at 1716 and 1725. However, the current and rather negative structure on the daily chart keeps the downside still vulnerable, with yesterday's low at 1634 offering initial support ahead of trendline support at 1623 and a key static support at 1612 low of 4th of April 2012. That would be all for today. We're back tomorrow at the same time at 7:00 GMT. Have a nice day.